Let's bring in Mark Avallone, president of Potomac Wealth Advisors. Mark, always great to have you, especially on a day like this.
Good to be here.
All right, so we got to talk about the markets first. Futures down, not down as sharply as we saw the markets close yesterday, but investors, they had a lot to digest. Obviously, highest inflation we've seen in 40 years, 7.5%. We also have the 10-year above 2%. And then we had one Fed governor calling for even more aggressive rate hikes than anybody else, pretty much. What do you see happening today? How did the markets shape up?
Well, we have a lot to unpack today. That's a big inflation number the market's trying to digest. It's all going to come down to this rise in rates, the pace that we've had. It's just been massive. It wasn't long ago that we were talking about a 10-year less than 0.75%, and now we're approaching over 2%. So this is an interest rate fear, growth stock takedown that we expect will continue. Rocky volatility. Uncertain markets. They're here to stay for several months. And I think investors absolutely need to have patience in an environment like this. Rising interest rates are not a friend to stocks when they're this rapid. One point is the stock market can handle rise in rates, but usually those rate rises would be more steady. It's the rapid rise here that's of concern. It's the inflation shock value that's a concern. And until things calm down, we think stocks follow suit.
Really quick, Mark, I want to correct myself. It was actually St. Louis Fed President James Bullard that called for accelerating rate hikes, a full percentage point increase by the start of July. When we talk about those three inputs right there, 10-year hikes and also inflation, which one do you think has the biggest impact on the markets today?
Well, it's a combination of all of them, but I think right now it's inflation. And the Fed speak yesterday saying we need a 1%. That's not going to happen. It's great shock value. It's a great way for him to get some press. Fed's not going to do that. I mean, your Goldman report there said they're going to stick to 25 basis points, and maybe they'll do a 50. So talk like that doesn't calm things down. This inflation number comes from several sources. The good news is some of those will be in the rearview mirror. Congressional spending drove inflation. Easy Fed policy drove inflation. Those are in the rearview mirror. Higher oil prices are driving inflation. Higher oil prices will work themselves out as more production comes online. And it's the supply shock that we're dealing with, and that will be in the rearview mirror. So if investors are patient and look through this into the second half of this year, I think we'll see that inflation, while not transitory, as Powell was saying all those months, it will lessen, it will subside, and that should give investors, long-term investors, more optimism.
So I know you aren't pro-value or growth. You say it makes sense to have a combination of both. When we look at the closes yesterday, I was pretty perplexed myself. You see Nike down 1%. You see Zoom down about 2%. Then you see a stock like Rivian, which is one of those high-growth stocks, down fractionally. And then you see a company like Thor, the biggest RV maker in the country, down about 3%. I'm trying to figure out, where do investors really see the risk? A company like Thor, for example, has very stable revenues, and it's actually grown its customer base, while Rivian should have been hit by that high interest rate.
Well, I don't follow Rivian exactly, although I understand they have a great product, and maybe there's some company-specific news. I think the reason people should be in both growth and value right now is you want some dividends to counter inflation. You want core investments, companies that are going to benefit from a growing economy, but you also want to keep your eye. You also want to keep your eye on the growth side, because if our thesis is correct and inflation does slow in the second half and we have a slow growth economy, we're going to be looking a lot like we were in the 2009 to 2017 period, where we had a slow growth world. And in a slow growth world, investors are going to want growth. So I wouldn't abandon the growth trade right now. I think it's an important part of investors' longer term portfolio, not to pile into all these value names and all these cash flow names. I get it. Strong balance sheets make sense. Avoid the speculative stuff. I'm totally there. But to think that mega cap cash flowing tech is not going to work through a rate hike cycle or beyond in a slowing growth world, that would be a mistake for investors to abandon technology.
All right, Mark Avallone, we appreciate the insight as always. Thanks.